Everyone is staring at the obvious move. Oil up, gold up, stocks wobbling. But that is not the real story. The market is not just reacting to a geopolitical headline. It is quietly rethinking a far bigger assumption, that inflation was on its way down and rate cuts were getting closer. That is why last week feels strange. The market is starting to question the path it had already priced in. This is the kind of market that exposes weak positioning fast. The real question is not, should I panic? It is this: what in my portfolio actually protects me if this gets worse? That is why gold and oil matter right now. Not as trendy trades, but as potential hedges. Some sell-offs are just noise. This one has a more serious shape because it touches energy, inflation, and central bank expectations all at once. The chain reaction is, geopolitical stress leads to higher oil, which sparks inflation fear, which leads to delayed rate cuts, and finally, lower equity multiples. That is why this market feels heavier than a normal dip. Gold is the cleaner hedge when the real risk is confidence erosion. It tends to make the most sense when investors start worrying about sticky inflation, loss of purchasing power, or broader market instability. Gold can help stabilize both the portfolio and the investor's behavior. Oil is different. Gold hedges fear. Oil hedges the shock. If the current market stress is being driven by energy disruption and supply risk, then oil is one of the most direct ways to offset that pressure. But it is a tactical hedge, volatile and highly sensitive to headlines. The better question is, what risk am I actually trying to hedge? If your concern is broader market fear and a shakier macro backdrop, gold is usually the cleaner fit. If your concern is further energy spikes and direct supply disruption, then oil is the sharper fit. The biggest mistake right now is not failing to hedge. It is buying a hedge only after fear already did most of the move. That is not hedging. That is reacting. A real hedge should make your portfolio more resilient. It should not become a new source of chaos. So what should you do with the portfolio you already own? First, re-rate your holdings by macro sensitivity. Which holdings need lower inflation to work? Second, separate business quality from valuation risk. A strong company can still be a weak position if the market decides the price you paid was too high. Third, if you hedge, size it like a hedge. A hedge should reduce risk, not become your biggest bet. Fourth, build a two-layer defense. Use gold as your core defensive layer and oil as a smaller, tactical layer. And finally, keep dry powder. This is not the time for hero moves. When markets get messy, most investors freeze or chase. The better move is simpler. Reassess your risk. Decide what kind of hedge fits, use a measured size, and keep your portfolio flexible. Thanks for watching. If you find this helpful, do follow for more investing tips and see you in the next one.